I'm summarizing two ways to pull the data from Yahoo Finance. I'm pulling the option table and pulling the consensus. Now this is pulling the option table data. On Yahoo Finance, for example, on this page, if I go there, I have this option chain list, and most of the time it's updated quite fast. If I want to get this inside my trading, and if I want to also get the analyst opinion in my Excel, and I want to use this to actually calculate the price implied volatility of the at the money option, so that I can find out the implied volatility by the market, which is a very good approximation for the risk because it's forward looking, it's traded, and it would get corrected if there is any arbitrage on the expected volatility in that stock. But what would be the return of that stock? Now, most of the consensus pricing are above and not below. Now, future prices are locked in by the arbitrage, but the consensus prices is based on a lot of things. They are based on a lot of estimates that are used by the equity research analyst, which is based upon earning, EPS, growth, a lot of things. They write big research reports. So we get a consensus of a price, a median price. So here the median price is 60, which says that after 1 year the price of Microsoft would be 60. That's very high. It's like 15% return. The mean target is 57. So I want to pull in the median target, which is the fourth value in this table, and I want to pull in all of these implied volatility. Now, to understand this, we have to understand a little bit of how these pages are structured, and we have two ways to pull it. One way here is to pull it by the table name. So the analyst opinion I am pulling by the table name. So I found that on like line 204, this was the median target, and the table class was this table, because if you see here, this is kind of a table, same table that goes up, so that's a kind of a table that they have used. So I'll pull all the values that exist in this this table with this kind of a font, and once I've done that, I'm going to use it. Contrary to this, here I'm going to use this table. So I will have 1 2 3 4 5 6 7 8 9 10, and I'll put everything, and I'll put like 10th or 8th of the row to get the number from this table if it's into that format. So based on that, I build up two logic. In the option table, I'm going to this site. I'm using win HTTP request 0.5.1. If I were to check, it's somewhere here. And then I am looping through to get to the element called option entry FZM, and I found out that every 8th element or 9th element is the one that I'm looking for. So when I run this, I get all the data pasted here. Also, I can use it later to refine the data. So when I run this, it's going to paste all the data here for the Microsoft options. And likewise, I am pulling the consensus estimate. Now, consensus estimate are estimates that are like annual, and I'm using them to pull the consensus estimate. So once I pull the consensus estimate, the idea is the same. I'm using this class from the website, and I'm pulling the consensus estimates. Once I have the consensus estimate, I can then use both of them in my calculation. So let me show you how this would work. When I pull this, I'll get the consensus estimate. I'm getting it here, but I'm going to edit it, but this is the consensus estimate. Once I have these two, I'm going to use it to calculate the daily VaR of that stock. So let me show you the VaR calculation. So once I pull the stock, I have the median, I have I'll divide estimate by current price to find out the annual increase for this annualized increase. I'll find out the daily expected increase. I'll find out the daily volatility from the volatility, and I'll find out a diversified, undiversified VaR, which would be a normally distributed number with a mean return of what we just calculated, a mean volatility of what we just calculated. The volatility of these stocks are there. So if you can observe, like Lockheed Martin or such companies have low volatility, and tech companies have high volatility because of their own reason. They are seeing a boom. So the best part is that everything is forward looking. We are not looking at historical volatilities. We are not looking at historical return. We are not looking at moving average return. We are not looking at any other return. We are actually looking at the return that is projected by the equity research analyst, because they are most close to actually analyzing the company, understanding the sector, and finding out what's going to happen after 1 year. So if in the long term, if that is the consensus, then we are looking at that. We can also store this data to actually observe what's happening and over a few months to see. Now, if the consensus report changes, generally it's published, I guess, each quarter when the earnings are disclosed, then our risk and numbers would automatically get updated. If there is an increase in volatility of that stock, maybe a merger or something was organized, then the volatility numbers would change. So we don't need to worry about anything that's happening in the future. We are already covered. If the company is planning to acquire somebody, it's going to be reflected in the call and put prices. It's going to be reflected in the next financial statement that are released. So on terms of volatility, we are covered, even if not in terms of the risk. But this would take a time to get to us. But if we sometimes it might come before, because just the news would shake it up. So even before a little bit, we can find out what's going to happen. So these are forward-looking estimates to calculate the daily VaR for the stock and find out which one is the most risky one.